Good evening, everybody. Oops. Late as I normally am. All right. Had quite a few requests to kind of go over what we might be doing this weekend. As far as the taking profits session, because it seems like, as well as recently, but through the years, the biggest problem most people have is when to take profits, because there's kind of a nebulous fear factor in taking profits, and I've got it listed as part of the list of why taking profits is a fear, because everybody's afraid to get out too early. That's right. So the biggest fear is what is normally human nature is, man, I don't want to miss out on any profitability. And I'd hate to sell something and it skyrockets. So one of the biggest fears of closing a position is this, that you look at something and say, well, it's time to close this, and then bam, they do that. You're sitting there thinking, oh, geez, how come it's always my luck? Or how come they always do that to me? They being somebody that we don't know who is they. But so this is the biggest fear factor. Okay. So what this is going to be teaching us, or what we should be learning through the process of using candlestick signals, is when it's time to close out a trade, close it, and then when it's time to get back into the trade, say, all right, this is a new trade, what do I do now? So the first thing that, they are the market monsters, is knowing candlesticks creates that natural discipline for us. And that comes from just knowing the sell signals. This is not a difficult process. So we're going to be going through, I haven't put them on the screen yet, but we're going to be going through 1, 2, 3, 4, 5, 6 kind of elements on Saturday of when to take profits. Number one is the sell signals. And then we're going to enhance that with next section, which is sell signals that are enhanced by selling at resistance levels, or being too far from the T-line, the T-line being a major factor of when we start coming out of trades. And we're going to be looking at some of these even on the live charts today. Or right at the T-line, how we use the T-line to tell us when to come out of a trade, and that is in the process of closing below the T-line, or identifying in the change of investor sentiment, even though we don't have a close below the T-line, that we start seeing sell signals, meaning look at all the indecision going on up here. Before we even get back to the T-line, it might be time to start coming out of that trade. So because we have a major advantage with candlestick analysis, it's all visual, we can use that visual analysis to assess what the probabilities are that things are starting to change. And where are they starting to change? We can see much more clearly when it's time to take profits, even though we're still above the T-line, with very simple observations like what is everybody else watching and what's happening to our stochastics. It's pretty much telling us we want to be coming out of that trade. So knowing the candlesticks allow us to accurately observe the obvious. So if we see something like this, where we can see what everybody else might be watching at resistance level, and we see them take it up and fail, and stochastics are already up in the overbought area, we can be moving a little bit quicker and saying, well, let's take a look at our 10-minute chart and see what's happening. So this is why knowing the nature of the candlestick signals gives us a much better perspective of what's happening in oversold or overbought situations. Remember what the doji and the spinning top and the shooting star, all those indecisive signals tell us. Obviously, there's indecision. And there's kind of a very simple rule. If we see indecision occurring in an overbought condition, that gives us an alert where we don't have to necessarily close below the T-line to tell us, well, maybe it's time to start taking some profits up here. And then if you add another factor like an observable resistance level, this is where we start getting into the mental psychology. What is there? Another psychology of saying, all right, we're starting to see weakness up here, and there seems to be a resistance level. Let's start thinking about closing out this position, even though we're not closed below the T-line yet, so we can move on to something that has better probabilities. What's our worst case scenario? We close out the position because it doesn't look good. We're in a higher risk area. Maybe if it does a J-hook pattern, we can always get back in. Yep. So when we get up here, what questions should we be asking ourselves? And two very simple questions. Which way are we going from here? The stochastics don't look good. They're heading down. Lots of indecision. We're still above the T-line, but is this going to go up, down, or sideways? If we can't make that assessment clearly with our visual analysis, the rhetorical question is, why are we still in this? When there's so many charts out there that we can say, hey, we know the probabilities are pretty strong, we're heading in this direction, versus the probabilities right here don't give us anything that we could say is advantageous. As a matter of fact, in a situation like this, the advantage goes against us because 2 out of the 3 possibilities at this point are not going to help us. It could move sideways or down versus only one possibility that it could go up. So if those are our probabilities, a lot of people just hate to, and I say a lot of people, this was me years ago, saying, oh man, it's still going up, still going up. Instead of saying, is this the best place to have our funds? And that's the thing that always kind of has helped me out quite a bit from taking me out of an iffy type situation so I can move my money back to a situation where the probabilities are much greater in my favor. So anytime I start seeing something that says this doesn't look good, let's start taking profits. It could pop up again, but what are my probabilities? Why don't I go find something that looks like this? Now, the fear factor, and this is how I overcame the fear factor. The fear factor is, oh man, as soon as I sell it, they take off and without me. Well, what I discovered is if I've sold here, knowing that I could buy back up here, and I move to a position like this, probably I'm going to forget about this trade, even if it still heads up, because I'm in something where the probabilities are much greater in my favor. The probabilities are greater in my favor, and the upside potential is much greater in my favor. There's a lot of times I say, oh, it's still going up, but man, I got into another position that worked out much better. So this is where you're kind of anticipating that things are starting to get toppy. Maybe it's time to come out of this position somewhere in here, or at least half the position, just to satisfy our own egos that if it does take off without us, we're still in half position. If it goes against us, we're out of the other half, but we got the majority of the profits of that trade. So this is what we're going to, this is the hard part. Whoops, I didn't read all the, did I? Okay. The sell signals at resistance levels, making it more probabilities. Gap ups, which is that enthusiasm that the Japanese rice traders have always professed, that when you start seeing enthusiastic buying at the overbought area, it's time to take profits. Or how we use the T-line to get ready to close out positions. How we use prices moving away from the T-lines to start anticipating taking profits. And then the subjective part like this to say, well, I haven't seen a sell signal to close below the T-line, but it doesn't look good. I'm going to go ahead and start taking profits and go find another trade that looks like this. So if we're anticipating, we need to see what the market is doing. That's part of that decision-making process, that if the market is still heading up, or if the market is rolling over, and we start seeing sell signals in the overbought area, say, all right, they're starting to sell off, there's been indecision, let's start closing out the trade, because this isn't looking good, and the market isn't looking good. If we're buying stocks for a specific reason, such as a breakout through a resistance level, and then we see a dark cloud, what's that tell us about our breakout through the resistance level? It didn't happen. Now, if you're like me, and I know some of you are like me, whether you like it or not, I bought this because I could see the doji sandwich bounced off the 34, looking for it to break through this level, going into wave 3, and it does this. Years ago, I would say, I'm going to give it a little bit more time because it bounced off the 34, it did a doji sandwich, and it's hovering right here. I'm going to give it one more day to see if they can get up through without saying to myself, hey, I can see exactly what everybody's decision was at a level that everybody was watching. They were selling. So I'm sitting here thinking, well, maybe they were selling, but my analysis was it should go up, instead of me saying the analysis is they were selling at that level. Milton, that's, yes, whatever makes you comfortable. And it keeps you in higher probability, or gets you out of low probability situations and puts you back into a high probability situation. So if I sold here and the next day I saw it close up here, I can always buy it back because my probabilities have changed for me. So this session is the kind of the training I've discovered in the past that most investor teachers do not address. They just kind of, I've found most of them just kind of slough it off and say, yeah, when you get up there and you got a good profit and it looks like it's time to sell, go ahead and sell. They never tell you what does it look like when it's time to sell. What we're going to be doing is kind of developing some natural disciplines just from the visual. It's going to be basically, when do you buy? What is the expectation and where do you set your stop? And then what we're going to go through is trying to eliminate the fear of taking profits at the appropriate time. Don't you need the dark cloud confirmed? Oh, Nan, where does a dark cloud occur? Sammy, hang on to your, unless that was one of the ones that we have already looked at. I don't think so. Save your individual ones until we get done with the live chart, the last chart. But don't you need the dark cloud confirmed and in oversold? Now remember, a dark cloud occurs when you're in the overbought condition. That's a sell signal. But it's a sell signal no matter, even though you're not in the overbought condition. Where did that sell signal occur? So this is what, I should say, Nan, I'm glad you asked that. Where did this signal occur? Right at a level that told you that they should be breaking out. But what did you get? You got a sell signal. So just because you're not up in the overbought condition when you got the sell signal, you did get a sell signal at a level that you were watching to make the probabilities of it heading higher that much better if it broke out. But this told you a completely different story. Going back to a very simple analysis. When you were buying here, what were you anticipating? You were anticipating breaking out through here, going into wave 3, the same as wave 1. That was the whole purpose of buying, was to get a breakout into wave 3. Or if I bought on this day, what was expected? To go in this direction. If it turned around and went this way, what can we say about our anticipation of what happened here? Number one, our expectation was that it was supposed to go in this direction. Number two, it did a sell signal right at a resistance level that everybody else was watching. That's probably two very good reasons to get out of that trade. Again, why was this being bought? Getting ready for a breakout into wave 3. So this is, again, just natural discipline telling us, all right, this trade didn't work. And the part of that natural discipline of a trade not working became much more palatable, if that's the right word, knowing that up 30% of the trades aren't going to work. Now, that's a very small percentage for most trading techniques. And I probably mentioned this before, that when I was trading futures for commodities, the adage at that time was that if you could hit 50% of your trades correctly, you were going to make a fortune. Well, that was before I started applying candlesticks to stocks, and I kind of made the, not a formal statistical computation, but it turned out that approximately 70% of my trades were positive. Again, some of them were at 0.3% positive, some were 300% positive. And I thought, man, I'm going to make a fortune. But now, I know there's another completely strong aspect to investing, that not only do you need to know what to do to maintain and maximize your profits on the good trades, but you need to know when that bad trade occurs and close it immediately. Okay. So not only are we looking to when to buy, what are we expecting, where do we set our stops, we want to start being able to assess where should we be taking profits, so that you now have just as much control of when to get into a trade and when to get out of a trade. So with that, I guess that's the link for the members discount to get in. Now, we're going to mix in oranges here. That's when to take profits. Here's our new trade concept. Remember, you've probably often heard me say, if we can analyze which direction the market is going, and then we can analyze which sectors are acting the strongest, and then we can analyze which stocks in those sectors are acting the strongest, that's basically putting all your stars in alignment. Well, we're adding another dimension to that. And right now, the assessment is, as you've probably heard me say, the electric vehicles are coming into not only great vogue, but probably have the prospects of very good long-term profitability based upon this market is just now getting tapped to where people are accepting the fact that electric cars are now feasible. Now, I know I'm going to be repeating myself, but I like hearing myself repeat myself. But the industry 2 years ago, when Elon Musk said, I'm going to do an electric car, they were expensive. The government was having to provide subsidies. They were helping to help subsidize that industry. And and so everything's being pushed toward that direction. And it's got great acceptability because obviously everybody would like to see cars that didn't pollute. And the other part that's making this business for that sector so strong, along with a chat be available after the presentation. So, Jim, you may still be driving it. You just may not be that hot catch that everybody's looking for. So, to kind of, you won't find gas stations. But here's the other side of this, and this is why we are setting up what I call RARE. Research, analysis, reverse engineering. Got to keep remember what I said. So research, analysis, reverse engineering is using the information that we get from our candlestick signals to say, hey, there's something going on here in this particular company or this particular sector. But in the case of electric vehicles, there's approximately 50 electric vehicle manufacturers or companies very closely associated to electric vehicles. Now there's another sector, which is obviously the charging stations. And then there's going to be another sector, just sectors associated with improving the electric vehicle area. So what is a second? It's research analysis, reverse engineering. Yep, so you've got the batteries. Oh, that's what it is. You got the charging stations, you got the batteries. There was another one I can't think of right offhand. So I should have spelled it out so I could even remember what I was thinking. Is there a list of the 50 or so? Yes, there is. Gas stations will change to charging stations. But here's why it is important to have this RARE, research analysis, reverse engineering, because I'm going to get into a hypothetical here for a little bit. But notice what's happened just in the last couple years of the battery capabilities. Now, 2 years ago, when Elon Musk was saying, oh, I've got electric cars, they're expensive, but you're getting subsidies from the government, and they can go 120 miles without a recharge. Well, 120 miles in this day and age, that doesn't get you real far. If you lived in Houston, Texas, and you've got a 65-mile commute to get from the Woodlands down to southwest Houston, and you got to get back home, that's 130 miles on a 120-mile charge, you're going to need a charging station. That makes companies like Blink, Plug, and some of those a viable investment. But now, look what's happened. Today, chip manufacturers, yeah. Will you be giving a list? Pamela, not only will we be given a list, this is going to be kind of this is not going to be something that we provide for you. This is going to be something that's available to everybody so that everybody can kind of be watching for the same things. So I've got the list of stocks. I'll have to remember who sent them to me. But the idea is Blink. Let me go to live charts. Let's see if I can do this. And this is, again, analysis that is going to have the reason the analysis needs to be, constantly monitored is hold on, I'm still trying to get this chart get in place. So this is Blink. Now, if you look at Blink on a long-term chart, say my long-term is 2 months or greater, and when it broke out, right here, our reverse analysis or reverse engineering would have kicked in. So, this is breaking out of a fry pan bottom. Why? Well, now we can go back and start doing some research. Well, Blink, not too many weeks ago, I didn't even know what Blink meant or what they did. Well, now we know it's one of the charging stations. That looks good. But remember what might have happened today when NIO reported that their car battery system now has the capability of going 625 miles. That has an effect that is beneficial to NIO, but it might be detrimental to some other car makers. Now, just as an example, I'm pretty sure Tesla backed off because of our normal process that we gapped up away from the T-line. There was probably going to be some profit taking. Can you please advise on how to find which sectors, industries are performing well? Tony, yes, we can do that on a very simple scanning process. Probably don't have time to do it tonight, but we can do it sometime soon. And it's very simple. You scan for the sectors just like you would scan individual stocks to see which ones are moving the strongest. So the rationale is if you see a stock or if you see a sector that is working extremely well, then you can go to that sector and find the individual stocks and do the same scan to see which ones of those individual stocks are acting the best of providing what we would consider the strongest candlestick buy signals. Will you be giving a list of various? Yes, Pam, it's not that I'm going to be giving. I'm going to be making all of this available, and it's going to be the type of thing where you don't have to, you can do it yourself, or you can rely on everybody else, not rely, but and do it in conjunction with everybody in the chat room to say, oh, look at XYZ manufacturer. They popped. Let's see what the reason was, and it's got a good signal. So essentially what we're doing is we're micro-analyzing a specific sector, basically due to the fact that the industry is expanding so, not the industry, but the technology is improving so dramatically that if somebody comes up with a battery 2 months from now that can go 900 miles without a recharge, they might now be in the forefront. Or, just hypothecating again, GP, who makes, they make buses up